Afternoon, everybody, and trusting everybody can hear me loud and clear coming across the airwaves this afternoon. Mark Solon here, back again this afternoon to present to you on a topic that's hard to make interesting, and it's basically financial protection in insurance, for want of a better term. What I'm trying to do with these webinars, and obviously I see a number of names there that I recognize from before. What we're trying to do with these webinars is make them educational, that when you go away from the session, either you're informed to ask the right questions or you ask them here today. And Dan, good afternoon to you. And what I would suggest anyone to do is there's a chat function there. If you want to throw up any questions as I'm going through this, if I get to them all, if I can't get time at the end, I'll get to them all and answer them. If not, as with all the sessions so far, and the feedback has been really good, there's complimentary consultations available for attendees, and I'll cover that towards the end of the presentation, towards the end of the webinar. But as ever, I do love questions. I do love people putting me on the spot and seeing if I can answer a conundrum that they might have for me. And as ever, if I can't answer it, we'll endeavour to get the answer. So without further ado, what we're talking about today, financial protection insurance, and let's hope nobody falls asleep, including myself, over the next 35-40 minutes. So just in relation to Symmetry, again, for those of you that have tuned in before, we are a brokerage firm. We're an intermediary. I have independent up there, and that's almost out of spite. We're not able to use the term independent anymore as per central bank guidelines. It's only possible to use it in very specific scenarios, but we are, for all intents and purposes, an independent company. The reason why they don't like us using it is we get paid commissions or referral fees, or trail or renewal from the various companies we use, but we're not linked with any specific company. We can do business with any in relation to this morning's business, in relation to any of the insurance companies that offer the business in Ireland. So if that's not independent enough for you, I'm not sure what is. In terms of the company, we hopefully have listened into some of the seminars before, and I'll just touch on what we have covered to date. But we are a mortgage house, very much so, for all types of mortgages. So if that's something you wanted to expand or learn more about, feel free to watch the previous videos, or come back to us, and we'll cover with you individually what the videos cover, the seminars cover in general. So the generic stuff. There's 8 staff and interviewing at the moment, trying to get good admin staff. So if anybody's listening, they know anybody, people in the financial services world looking for admin or paraplanning roles, please feel free to send on my details. So might as well be cheeky. In relation to what we've covered so far, we've covered mortgages, how they work. We've covered the mortgage process, so what the banks look for. We've covered investing in property, whether that's an individual, a corporate, or a pension. We've covered budgeting. We've covered money management, and more recently, we've covered tax. And happy to revisit any of those, covering or focusing in on any of the topics specifically. If there's an appetite, you can just let Dylan or any of the guys at Umbrella Wellness know what it is you would like to learn more about, and we'll basically put a presentation around it. So this morning or this afternoon, we're going to look at life insurance. So why you might need life insurance, what is life insurance, how does it work, what's the difference between life insurance and mortgage protection. So some people, they have a very, very confused understanding of what they are as products. What's the difference between life insurance and life assurance? I'm going to answer that one here and now, because I don't actually have a slide on it. Life insurance and life assurance, for all intents and purposes, are the exact same thing. Historically, there was significant differences in how the policies were structured. In that a life assurance policy tended to be a reviewable policy with a savings element or an encashment value. So there was a savings and life insurance portion together, whereas life insurance is purely the risk element, purely the insurance side with no savings. The savings type products are much less prevalent than they would have been. For example, I'm in the industry 16-17 years, and I've never sold a life assurance policy, but needless to say, the term is still bandied out there. Okay, what is critical illness, what's serious illness, what's income protection, what's salary protection? Again, different terms for pretty much the same thing. The different types of cover you can look at, and then look a little bit on health insurance, car, house, travel. I'm not sure if actually if I included that at the end. So just getting straight into it. So what is life insurance? Why do you need life insurance? So again, what is it? So unfortunately, if you have taken out life insurance and the policy has been exercised, it means that you are no longer with us. So it means you passed on, and you had made prudent financial decision in advance. Obviously, you don't typically plan for death, even though it graces us all at some stage, but typically in our elder years. So when you are taking out life insurance as a 20-something, 30-something, 40-something year old, it's more of a in the event of, in case of. It's not that it's something that you're planning. And again, unfortunately, it does visit some people's doors sooner than they would like. But the reason why you would look at life insurance is you have a family. So that's the number one thing. I've 3 little torturers at home, and I couldn't imagine what would happen if something happened to me. Again, my wife has a good job as well, but it's a 2-income household. My income goes a long way towards the house. You want to make sure that the kids the children are financially looked after in the event that something happens to me and or my wife in this case. Okay. If you have loans or mortgages, now everyone will look at taking out life insurance on a mortgage, but you may not look at having life insurance to cover things like a loan. Now, a 5 grand credit union loan isn't going to be much of an issue, but you might have a 35 grand car loan. Again, you can argue you can sell the car, and there's all those angles on it. Or you can have a life insurance policy that covers the mortgage plus any of these ancillary, this ancillary debt. So very simply, if something happens to you, again, in the event of death, the debt, the DEBT, is financially covered. So there's no pressure on your next of kin, on your whoever you're leaving behind. There's no pressure on them to cover any of these outstanding loans. Okay. Another one is why you might have cover is if your partner isn't insured or doesn't have relevant cover through their job. I'm going to cover this a little bit more detail as we go along, but this is equally relevant for yourself and for them. So should they have insurance? Should you have insurance? So if your partner or your spouse is a homemaker, you might turn around and say, well, they're not earning a salary. Should I insure them? Absolutely, because there's a value on the homemaker, and it's typically your average industrial wage. So that means that they do need to have the cover in place. Okay. If you don't have cover through your company, now I'm going to assume most of the people listening in today, because your employer has gone to the trouble of engaging a wellness program for staff, I would assume that most of them will have adequate cover from today's presentation as part of your employment. You might know you have it, and probably one of the things you'll do after this session, which is common, is you'll go off and you'll find out what you have, which will be peace of mind for you. What it may not mean is your husband or wife or partner or significant other has the cover in place. Okay, so larger companies, especially the multinational companies, do tend to look after their employers extremely well when it comes to today's session, and this is more that you are aware of what they provide, because oftentimes there's a knowledge gap. You have it, part of your contract, you don't read it, you don't understand it when you do read it, and nobody explains it to you, or they do explain it to you, but they don't do it in a clear, concise manner, because possibly they don't understand it either. Again, been around the block long enough to see all variations of the aforementioned when it comes to insurances through your employment. Okay, and you may not be in a pension scheme. So I'm throwing that in there because pension scheme is part of your financial wealth, your financial planning, and if something happens to you, it is left to your next of kin in most cases. So if you're not in a pension scheme, you don't have cover through your job. If you or your partner don't have independent cover, you have debt, you have a young family, there's 5 reasons straight away why you need to look at having cover. On top of all of that, again, boils down to how much do you want to protect your next of kin. So if something happens to you tomorrow, how much financial security do you want them to have? So I'm self-employed, going on, this is into my 8th year this year, and one of the stipulations when I went self-employed by my wife was to make sure that I was adequately insured. In fairness to her, she was on the button, but making sure that if something did happen to me, because I was no longer in a large company, that I had the relevant cover in place to make her life comfortable after in the event something happened to me. Okay, it's typically a lump sum and it's typically tax free. So that's the good news. And I have put in there, usually it's not always tax free. There's scenarios where it may not be. Okay, and that's really down to inheritance. And it's typically replacing my salary. So if I'm on a 50,000 euro a year or 100,000 euro a year, and I have 300 grand worth or 300,000 euros worth of life cover, well, you might turn around and say, well, I'm on 300,000. It's only covering 3 years. Well, it's not, because it's in most scenarios, it'll be tax free. So then it's working off, what your net take home paid. So the tax, your income after tax. So your post tax income. So what you get in your wallet or in your bank account every month. So that's the figure that you really are concerned about, okay? As well as that, if other costs are like mortgages and things like that have been paid off, then how much extra life cover do you need? But it's basically how well do you want to protect your family or your loved ones, whoever you're leaving behind, tax free, as I said, and it's usually paying off an income, replacing an income, or paying off debt. Ideally, it's doing both. So ideally, the debt is gone and income replacement, a substitute for your income to cushion any blows there or any significant drops in your income into the household. Okay, what's mortgage protection then? Mortgage protection is life insurance. So just straight off the bat, it is exactly the same thing in that it's life insurance. The difference being, and it's called mortgage protection because 90% of the time it's connected with a mortgage. It's decreasing life insurance. So it's basically where the cover you take out decreases over the term of the policy. It pays off the mortgage that you've taken out with the bank in the event that you die and or your partner dies. Okay, so I have a 300,000 euro mortgage with Bank A. I get hit by the bus crossing the street. That policy pays out, goes via my solicitor to the bank because the policy has been assigned to the bank in a legal process. The bank have the ownership on the policy. The 300,000 euros or part thereof clears the mortgage, and if there's anything left over, then that surplus goes to my next of kin. Okay, so hopefully everyone picked up on that. But ultimately, a mortgage protection policy is life insurance with the goal of clearing my mortgage or mortgages. If you're in a lucky enough or unlucky enough position, depending on how you look at it, to have more than one mortgage. You have to take out mortgage protection cover in Ireland, so it's a stipulation on all principal dwelling mortgages. It's not a requirement on investment mortgages, so the banks typically don't require it on an investment mortgage. Some banks will, most banks don't, because it's not a requirement. However, on a principal dwelling, and what I mean by a principal dwelling, the house you plan to live in, it is a prerequisite. Okay, and the idea behind mortgage protection is you don't leave any debt, DEBT, you don't leave any debt behind for your next of kin. So you might be asset rich in that you have 10 assets, and I do a lot of work with investment property investors. You could have 10 assets leveraged at 50% loan to value, and in your mind you're thinking, well, do you know what, should I have insurance to cover that 50% or 30% on that debt, the DBT? Well, the answer is you should, because otherwise, because you might be that particular individual, and I have this conversation more often than you would think, that particular individual might think that, well, should have the houses and they have the rental income coming in. They do, and they have all of that, but maybe they don't want it. So maybe they don't want to have all of the property. They don't want to have the headache of managing 10 properties or a portfolio of assets. Maybe they just want the cash, in which case then they have to go and sell. There's fees and all of that kind of crack. Whereas if there's a life policy in place, it can either be used to pay off the debt, or it can be given to the individuals to cushion any blows in loss of earnings. Okay, so just again, why you might have it, there's a little add-on there as well. If you have life cover on a mortgage and it's an investment, it tends to be tax deductible. So revenue allowed for tax deduction purposes, which means that you don't pay the full premium. Half of it is typically going to be taken in tax, which is a good thing for once. So explaining how it works. So I've just done a little grid here, explain the difference between level term and decreasing term. So term protection and mortgage protection. Okay, so the first one is the decreasing or the mortgage protection. I have a €250,000 policy over a 25-year period, and what's going to happen is over that 25 years, my cover is going to decrease to the point that at the end of the 25th year, my policy has zero cover. So obviously, if something happens to me here, I'll have, let's say, a couple €150,000 worth of cover. Something happens to me here, I might have €25,000 worth of cover, and then at the very end, the policy expires, and like the mortgage is now gone, the protection policy is also gone. However, normally there's a bit of value in the policy in that, because there's an interest rate used with mortgage protection policies, and obviously there's an interest rate associated with the mortgage, and one is generally bigger than the other. Because of that, there's generally a little bit of fat left over on a mortgage protection policy in the event of a claim mid-mortgage. So your mortgage is 300 at the start, so is your policy. In 15 years' time, your mortgage is 150. The life insurance policy could be 162. So there'll be a little bit extra there left over in the event that something happened to me. That €12,000 would sit with the solicitor, pay their fees probably, and go to whatever other and additional costs that might be associated with it. What a level term policy does is the €250,000 stays the same over the 25 years. So day one, I'm insured for 250. Year 25, I'm still covered for 250,000. What I can also include on that €250,000 policy is indexation, where the level of cover will increase, and it varies from company to company, anywhere from 3 to 5% per year. So if you start with 250 and you took indexation every year, the 250 will be closer to 400,000 in 25 years' time. Okay, and the premium will go up along with the cover. So you pay extra on the premium, you pay extra for, you get extra cover, and you pay extra premium for that cover on that indexation basis. You can also add on what's called a conversion option. Two types of policies Symmetry Financial we sell is we either sell you the cheap and cheerful mortgage protection policy because it's decreasing and it's what you have to have, or we'll sell you the term convertible policy, the conversion option. And the reason why is the difference in price is generally negligible. So what a conversion option means is where the term is 25 years, your policy at the outset says convertible on it. What that means is at any stage over the 25 years, you can convert that policy into a new policy without any further medical evidence. And again, let me give you the scenario. I'm 30 years of age. I take out my first buy my first house, take out a 25-year mortgage with a life policy, and I decide to go level term on it. I'm now 54, 25 years later. Let's fast forward. I'm 54, my mortgage is gone, but I still have this policy for 250 in place. Now, scenario A, I'm as healthy as a flea. I've just run the Dublin Marathon and I'm getting ready to climb the Alps. So I don't necessarily need cover in my head because I'm a healthy punter. So the conversion option for me, I have it on the policy. I may not convert that policy into a new policy. Scenario B, I've taken up smoking and I do no exercise and I've ballooned in weight. I'm 55 years of age and I look 85. That punter, the exact same age, the exact same policy, they can convert that into a new policy without any further medical evidence. So client A, who's as healthy as a flea and may or may not convert, and client B, who's gone downhill dramatically, they both convert the policy and they both would pay the same premium based on the executing the convertible option on that policy. So hopefully everyone understands that. It basically means in the future, you can convert the policy without additional medical evidence. So you're locking in your health from day one, and hopefully on day one, you're healthy. So all things assumed there. The different types of policies then, so you can obviously have a single life policy. So why would it be a single life policy? Because it's just me. So I'm the only one on my mortgage. Then you have joint life insurance. You see the banks selling this type of insurance where it insures two people, but it only pays out once. Okay? So again, myself and my wife, if we go back to the €250,000 example here, on a joint basis, that policy will pay out once. So typically on first death. So I get hit by the bus, the €250,000 is paid out. My wife gets hit, unfortunately, by the same bus the next day. There's no payout because it was a joint policy. You can make a dual. I should have said there, I hadn't brought up, there's two types of policies we sell in Symmetry Financial. It's dual decreasing or dual term convertible. Okay, and that's really what I get you to take away from it today. If you see joint coming up on a policy from a broker or from a bank, thank them, shake their hands, and either hang up or turn off the Zoom, because I was going to say walk away, turn the Zoom call off, because they either don't understand what they're selling, which does happen, unfortunately, or they're not mis-selling you something. They're just underselling you. They're giving you bad advice. Okay, but you see this joint thing coming up, oh my God, on existing policies more often than I would like to see. Okay, so dual basically means the 250,000 euro scenario. I'm hit by the bus, 250,000 is paid out. My wife is hit by the bus the next day or the next year. If it's a dual, if it's a level policy and it's dual, another 250,000 is paid out. So you're paying a premium for 500,000 euros in a dual scenario as opposed to 250 in a joint scenario. Obviously, if it's decreasing on a dual basis, it'll be whatever the value of the policy is at the date of claim. So in 15 years time or 20 years time, the 250,000 will have reduced significantly. But same scenario, if it was a dual claim because both individuals claimed, then it would pay out twice, and the benefit would obviously go to the bank, followed by going to the next of kin. Okay, so hopefully everyone gets a grasp on the dual versus joint debate. That's as much as I have time to go into that today. So the difference then between life and mortgage protection, very simply, one is a lump sum for family, and the other is a lump sum for the bank and or debt. One, the level of cover is fixed with this conversion option. The other one is reducing cover. You can add conversion options to mortgage protection. Again, I need another few slides to get into all the variations on the cover, but I just want to keep it simple for people today, just in case people are saying, I thought you could do conversion on mortgage protection. Yeah, actually you can, and it is an option there. But again, if you're looking at conversion, you should be just saying, okay, I'll bite the bullet and go with the level policy. Typically costs more because you're paying for more. So you're paying for a policy that doesn't decrease. And as a result of that, the cover is obviously going to cost more. But the younger you are when you take the policy out, the less of a difference it is. So when if you're in your 20s, the difference between a 300,000 life insurance and a 300,000 mortgage protection is going to be peanuts. Okay. And you choose to take out life insurance, whereas you must take out mortgage protection because the bank will stipulate it on your loan offer. What's critical illness then? Firing ahead. So we've covered life cover to death. Pardon the pun. Serious illness is I haven't died. I've been diagnosed with a critical illness, and it's paying out a lump sum as a result of that critical illness. And the main reason why 80% of claims, over 80% of claims on a critical illness policy will be cancer related, heart related, or stroke related. They're the three big ones. And then every other illness, of which there can be up to 70 illnesses covered depending on the insurance company. There's huge variations of cover that you have on a critical illness policy, but the three main ones will always be cancer, heart related, and stroke, with, again, of a certain severity with cancer, clinical proof with heart, and specific symptoms with a stroke. So it has to be at a level, a critical level or a serious level. And the lump sum is paid, again, it's paid tax-free, and it's either used to pay your bills, used to pay a chunk off your mortgage, and or used to replace some of your income going into your household. That is pretty much what critical illness is. So I probably should have mentioned at the outset, and probably as good a time now as any, the reason why you do or you don't take out this type of insurance that I'm covering today is either you want to pass the risk on to a third party, or you're happy keeping the risk on your own shoulders or within your own four walls. That's basically the reason or the rationale behind insurance. You either take on the risk, or you pass it. You take it on yourself, or you pass it on to somebody else. Okay. So why might you look at critical illness? Again, it's how do you pay bills if you're out of work? Does your employer pay you? So I'll touch on that in a minute. Your government, will the government look after you? The government have a disability benefit there, or an illness benefit. It's 203 euros a week. It's paid for, I'm going to say 9 months. Used to be 12 months, and after that then means testing comes into it, so you may not get it past that date. Will your employer look after you? How long will they look after you? You have health insurance, surely that's enough. Again, we'll touch on that. You've heard that the claims aren't paid. There'd be a certain truth on that, but the number of claims that are paid are still high. It's about 85%, varies from insurance company to insurance company. But typically you're looking at 8.5 out of 10 claims are paid. The reason why the balance aren't going to be paid is either non-disclosure. Again, that's a presentation in itself, where you don't answer the medical questions at the outset in an honest fashion. So there's 15, 20, up to 40 medical questions to answer when you take out life insurance. And if you don't answer them honestly at the outset, and then you have a claim and it crops up that on your medical records with your GP or somewhere out there that you did smoke, or that you did have a family history of cancer or this or that or the other, and it wasn't disclosed, then you're giving you're giving the insurance company a reason not to pay the claim. Okay, so that's what's called non-disclosure of material fact. But outside of that, 85% of claims are going to be paid. Okay, income protection, you might have that in place. Again, valid reason why you may or may not consider serious illness or critical illness. What's the difference between critical illness or serious illness? None that I'm aware of. It's just some insurance companies call it one, some other ones call it the other, and then you also would see specified serious illness. So different names depending on the insurance company. Now to scare the pants off you. So some scary facts in relation to life in Ireland. About 28% of deaths every year are heart disease related, so heart related. So it's a fairly high and scary statistic. The next one, which I was shocked at when I was doing my research to update my slides for this, every 3 minutes there's a cancer diagnosis in Ireland, and every hour someone unfortunately kicks their clogs as a result of cancer. And if you're a couple, there's a 1 in 2 chance of suffering from one of the three before age 65. So not here to present a doom and gloom. It's all out there on the internet, as they say, but it is something that you do have to take into account when you are deciding whether or not you take the risk on, which is example there, or you pass that risk by paying a premium to a third party, which is in this example an insurance company. Okay, so why should you review it? So let's assume you have insurance in place. So why should you review it? Make sure you're not underinsured, but also to make sure you're not overinsured. Believe it or not, there are individuals out there that tend to be overinsured. Who? People in the public sector. We deal quite a bit with the public sector, so it may not be you, it may be your partner or your spouse, and they have all the insurances that have been sold by some broker visiting their workplace, but not taking into account the fact that their husband or wife is underinsured. So there's a balancing act or a scales act that has to be carried out there to make sure that both sides have equal cover in place. Make sure you don't overpay for your cover. I'll show you that in a second. And finally, your life changes as you move throughout your working career. So 8 years ago, I didn't have a child. We obviously always wanted to have kids, and we're lucky enough now to have three kids later. And everything changes. So you're outside of the fact that there's not enough month at the end of your wage, you're running out of cash and all the other calls on capital. The reality is that you want to make sure that they're financially set up for life. So that tends to be the real instigator and driver for people when it comes to reviewing this type of stuff. Okay, so an example then of a quote. So we do research reports on every client, service we pay for. And this is just, there's a lot of numbers going on there, but I just went for a single application, a single applicant example here. And it's just to show you the variation in prices. So for example, there with this individual, they can do the decreasing mortgage cover, which is 17 euros a month, or they can do the convertible term cover for 25 euros a month. So for the difference in that example there, it's 8 euros. They're getting that, in this case, it's 330,000 life cover over 30 years. The convertible option means the 330 stays 330 for the next 30 years, whereas the 1732 means it decreases. On top of that, we have discounts with a lot of these insurance companies that we always pass on to our clients. Again, I can't comment on every company out there. So in reality, those premiums will be down closer to 20 euros a month and 14 euros a month, respectively. Okay, and then when you're into the critical illness side, you can see the difference there between the convertible option and the mortgage. So it does jump in that scenario. And the reason it jumps is you're taking critical illness on a level basis. And statistically, which I'm after showing you, statistically, you're more likely to claim on a critical illness policy or a serious illness policy than you are on a life insurance policy. And because of that, the critical illness pushes up the price. Instead of paying 43, going up by 8 or 10 euros, it goes up almost double in this example, because the critical illness premium is it's expensive. Some people will argue when you work it out that it's not expensive compared to what it would pay out, but it's more expensive than life insurance, maybe is the way I should explain it. Okay, and all we do there is we're looking down through the policies there. Who is the cheapest? So if you're looking at the prices there, New Ireland is 90, Royal London is 77, Irish Life is 88, Royal London is 77. We actually get the anywhere between 5 and 15% off those premiums. Whereas if you've gone directly through a bank, every bank you go through will be Irish Life, except Bank of Ireland, and they are New Ireland. So if you're looking at this thinking, oh, I took out my mortgage with Bank of Ireland and I sorted my life insurance with the bank official Bank of Ireland Life, now you're realizing you should have reviewed it with a broker or independently, because you're paying, in that example there, you're paying 20 euros a month more than you need to pay. Okay. So a life cover in terms of public versus private, again, because obviously there's I don't expect any public sector employees to be listening today, but you might be married or partnered with one or have family members. And typically the private sector have the mortgage protection and life cover, and then do they have any cover through their job? So there tends to be a deficit or a deficiency between the public sector employee or the private sector employee. And if I put another column there saying self-employed, the deficiencies and the deficits will be significantly greater. Okay, so one thing that I'll be telling everyone to do is, once you've finished listening to this, obviously hear me out for the next 15 minutes, and then find out what cover you have through your job. Okay, just a few do's and don'ts. So we always like to give you tips. I'm going to put them up there because I'm going to fire through them. Obviously, review what cover you need. Make sure you're not paying more than you need. Make sure that you are adequately insured on both sides. If it's a couple, live healthy. So again, that goes without saying, but tongue in cheek, if you're a healthy individual, life insurance is cheaper, because the prices you see are the prices you pay, as opposed to having loadings applied to the premium for riskier lives. Okay, and risky life can be a BMI issue. It can be BMI, it can be diabetes related, it can be high cholesterol, high blood pressure. Smoking is huge. I have it in there actually. So if you do smoke and you quit, get it re-quoted, but you need to wait 12 months. Be honest with your answers to the questions. Consider writing the policy in trust, or consider life of another. And it just, again, this is something we touch on with couples who take out mortgages that aren't married. And it's really important that they are aware of the fact that they're strangers in the eyes of revenue for inheritance tax. So if myself and my partner buy a 400,000 euro house together and she dies, the policy pays out because we have it in place, but her half of the house, which I'm going to receive, because we're partnered but we're not married, I owe tax on half of that. So I'd be hit with 33% on the 200 grand minus my my level C exemption or category C exemption, which is just over 16,000 euros. So I'd be paying close on 65,000 euros in tax. So what I can do is I can have my life policy for whatever the mortgage is and just add that on top. Okay, so again, a little tip in terms of life of another and or policies in trust and or if you are partnered. Okay, and you don't have to overpay for older policies. It is worthwhile reviewing to make sure that you have everything in place. So we do all of that for you. We check your premiums. We make sure that you're not overpaying for it. And if there's a need for it, we can recommend a policy. And we have that price match software, which I've shown you there, which, with the discounts, you're always going to get the best price that's available out there. Plus you're getting the advice for the cover you need. Okay. So in relation to critical illness then, so what is critical illness? I've covered that already, yeah. Income protection, sorry, that slide shouldn't be there. So income protection or salary protection then, so what is that? It's basically, it is what it says in the tin. It's insurance that protects your income. Salary protection, income protection. The industry term for it, which is a bit confusing, is PHI, permanent health insurance. But It's nothing to do with health insurance, it's to do with salary. So the idea behind income protection is if you were out of work and if you're out of work and you're not covered through your employer, or you don't have any insurance through your employer, can you survive on the disability benefit, which is 203 quid a week? So will that stretch far enough to cover your bills? So that's the question you're asking yourself, okay? And if you're a one income household, it would be very, very difficult. Even in a two income household, it would be quite difficult. So what it looks like then, if we put it into action, if you're employed, and this example here is a 45,000 salary. So I've just gone with an industry average wage, 35-year-old, 45,000 salary, A-class PRSI with 13 weeks. That should say 13 weeks employer illness benefit. So if I'm out of work and I'm unable to come in to do my job, my employer covers me for 13 weeks, which is 3 months. So I still receive my 865 euros a week. Okay. What happens after that is I drop to the illness benefit payable by the Department of Social Protection, which in today's world is 203 euros per week. So it's about 25% of what I was earning once I go out sick. Okay. And I'm off the payroll with my employer. The first question I always get you to ask is, do you have the cover through your job? Okay. And your employer will either get you to pay for it, or they will pay for it through a group scheme, typically through the pension scheme, or through the insurance company that provides the pension scheme. You can insure yourself up to 75% of your pre-disability salary, minus any other benefits you're in receipt of. So if I'm on 865 a week, I can cover myself up to 75%, of which 203 is social welfare, and the balance 445 comes from the income protection policy. And that is pretty much how it works. And the idea behind income protection is it's a cushion. So if I end up falling sick, ill, unable to work for whatever reason it might be, and my employer doesn't pay me past a certain time frame. So bear in mind, some companies don't pay any illness leave, and some companies will pay you up to 6 months. So it will vary from employer to employer. 13 weeks is picked because it's in the middle. You can have the insurance, and the insurance pays you for that period of time. Okay, that's pretty much income protection. So what is it about? What would you do? First of all, check with your employer. So do you have this in your job as part of your contract of employment? And if you do, happy days, because it isn't a cheap insurance. Again, why am I saying that? Because again, statistically, it's a policy that's claimed on because it's something's preventing you from working, and it's not necessarily a serious illness. Income protection, some of the insurance companies will tell you that it pays out more for mental health related illnesses and spine related or back related injuries than it does for a critical illness. So again, just as an FYI, income protection is covering anything that prevents you from doing your job. It is a tax deductible policy if you do not have it through your job. So if the premium is 100 euros a month, it's costing you 60. If the premium is 50 euros a month, it's costing you 30, assuming you're the higher rate taxpayer. Okay. And then how much cover do you need? You don't necessarily need the 75% cover. You can get away with having, you don't need the 75% cover. You can get away with having less. So if you're on a bigger salary, you certainly wouldn't need 75% unless your outgoings are extremely high. The lower salaries, you tend to veer towards the maximum 75%. But it's certainly a case by case, and it's something that I would always tell people to be aware of. Again, do the risks, do the analysis. Do you need it? Can you take the risk on your own shoulders, and then decide? And then, so that's the main types of insurances. Then there are other bill paying type insurances you can have. There are broken bones. There's which isn't income protection, as in preventing you from doing your job, but it pays you if you break bones, sports related injuries and stuff like that. Again, I've always reviewed them and looked at them. They are there. Gardaí actually tend to take out those policies quite a lot, and people in the prison service tend to look at them as well. Injury policies as opposed to income protection, but the premiums don't tend to be tax deductible, and the premium tends to only pay you for a very short period of time. Whereas going back to the income protection scenario, the cover, once it's in place, pays you until you're able to go back to work, or the ceasing age of the policy, which is typically 65. So in theory, you could be a 35-year-old father or mother of 3 kids and be struck down with a serious illness or an accident, and the policy pays your wage for the next 30 years. Okay, whereas an injury policy will typically only pay a fixed amount for a 52-week period, so a year, and a serious illness policy pays out a fixed amount of money. Okay, so income protection has a huge potential sum insured, which is where they can be expensive, again, subject to what your profession is. Okay, happy to discuss it in more detail and show you how it would work specifically to the listeners if you don't have a 3-year job, and if you have a 3-year job, well done. Great employer, and for those employers that are listening that have engaged to put it in place, fair play. Okay, in terms of insurance tips, then again, it applies to all types of insurances, making sure you review your insurances, making sure you don't overestimate how much you need, or indeed making sure you don't underestimate how much you need. And that applies to life, serious illness, income protection, travel insurance, health insurance, car insurance, house insurance. I have it in my own house insurance. I'm reviewing it at the moment, and lo and behold, Zurich, who I like as an insurance company, Zurich are indexing my policy because they think it's going to cost me more to build my house than it did 12 months ago, increasing the cover and by, I think it's 3% and pushing up my premium by 40 quid a year. So thanks, Zurich. But in reality, you just need to make sure, do I need that cover? And if I don't, can I shop around and go anywhere else? Okay. In relation to car insurance, again, I'm going to put it all up there because we're coming to the end. It's getting the right cover, no claims discount, so common enough stuff. Avoid convictions, avoid penalty points. Again, that's all blatant enough. Choose your car wisely. A lot of people mightn't think like that, but the bigger engines and the older cars equals higher premiums. And checking for discounts online. So what I'm seeing now is you get the discounts for providing the quote online. So it's speeding up the process for the insurance company, whether it's the AA or whoever it is that your Zurich or Allianz Direct or wherever you're going through, that you're doing a lot of the work initially. So then when they're on the phone to you to go through the T's and C's, the work is predominantly done. And as a result, they're giving you a bonus or maybe a couple of £100 off or £100 voucher off the policy. So again, bearing that in mind. Equally so on Post, for example, do deals if you have the 2 policies with them. Okay, because I was with On Post for a little while myself. The problem with all of this crack is if you don't review it, the premiums sneak up and you end up paying extra. It is quite annoying on car and house insurance that you do have to review it every year. Some policies are out there that you can lock it in for up to 2 years. House insurance is the same thing. I'm after using myself as an example. Make sure you're not overvaluing how much it's going to cost to rebuild your house. The SCSI have a calculator there to give you an indication of the rebuild, the rebuild cost, and then you make sure that that's how much you have on the policy. You're avoiding indexation. I'm after mentioning it. Insuring your contents, making sure you're not over-insuring your contents. And if you do, you know, I've a number of bikes, and for me to insure my bikes was going to be quite expensive. So what I do is I keep a number of them in the attic. Okay, so little things like that you can do to keep your content insurance at a lower price. Checking for value, checking for excesses, pay it annually makes it cheaper, and then the same thing for online discounts is plus or minus the alarms and the smoke detectors and all of that crack that comes with the house insurance. And life insurance then, finally, the way it works with life insurance, anyone that's has life insurance for the last 5+ years will notice that the costs have increased unless you're shopping around. You might be lucky enough that your employer pays it for you and then you have a BIK element to it. But health insurance costs have increased or spiraled dramatically over the last 10 years, far outpacing inflation. It's one of the larger expenses, in particular for elderly people who are often afraid to review their health insurance. So this may not be relevant for you, but it may be relevant. Now you're pricking your ears up. It may be relevant for your parents who are with VHI since the day the health insurance was a product and are scared out of their mind to move from VHI. Okay, so there's loads of little things you can do, splitting your cover, smaller excesses. We have partnered up with Dermot Good. Dermot and I used to work together many years ago, and Dermot, he reviews my own health insurance every year around the turn of the year. And Dermot's service, it is a fee-based service, in which case you know you're getting good quality advice. You have Irish Life, you have VHI, you have Leia, and Dermot will do the analysis for you if you have the wherewithal and the time, you can go to the HIA, the Health Insurance Authority. They've got fabulous tools on their website. I used to be an expert on health insurance, got out of it, and once you're out of it for 6 to 12 months, the thing changes so quickly that you need to be dealing with somebody that's on top of it literally all the time. And Dermot, I can only recommend him. If it is something you want to review, come to me, I'll introduce you to him, and he does have a fee there, but he does a discount for any of the clients that we send on to him. Okay, how you book a consultation with us? Pop onto our website there, or drop us an email at symmetryfinancial.ie. But on the website, there's a book consultation option there. My details as well, my email address is coming up there on my mobile. Preferably an email at the moment, and any of the scenarios and any of the questions that you have on today's session, please fire them across to me. If there's any questions, let me have a little look, and if there's any questions, and there isn't, that's it. So 45 minutes on the buzzer, guys. Nobody's engaged. Hopefully you've learned something there today, and you haven't all fallen asleep and grabbing your 40 winks over the last half an hour. And with that in mind, we'll sign off here, and Dylan will put up the slides. He'll send the slides around. I'll get them to him later on. And thank you very much for logging on, and I'll talk to you all again over the next week or so. Thank you.
Thanks, Mark. And yeah, the slides will be available on the Well Player later on this evening in the Downloads tab. So thanks very much, everyone.